Okay, this is a video where I'm making a video to test out. I'm making a video to test how long this is going to take, because after I had a really difficult experience with a class, trying to explain some of the nuances and the valuation issues that arise for analysis of a renewable energy asset, a renewable energy portfolio of assets, or a company that owns a whole lot of projects and also has the potential to invest in new projects. So I'm going to do this. I'm doing this really to test out how long it's going to take. I'm embarrassed to say I just made a whole video and I didn't have the sound set up correctly. So I'm remaking this video, and I think it's going to take about an hour, or maybe a little bit longer than an hour. Okay, now I'm going to, in this video, I'm going to have two case studies. No, I'm not going to open Excel. This might be the first video I've ever made where I don't even open Excel, but I'm going to talk about a lot of modeling issues. In a second video, I'm going to use concepts from this first case study and put these concepts into kind of Excel financial modeling. Again, I'm not going to do a whole bunch of modeling. I'm going to show you kind of the issues. Now, the case I'm going to use is Orsted, a Danish company. And this company is, for me, a very interesting case to look at. And it really shows you some of the nuanced issues in modeling renewable energy investments. Okay, this company was at one time, I think it was had the largest market capitalization in all of Scandinavia, but it's had a bad time. Its price to book ratio, or its stock price declined by 79%, and all of that is due to one or two projects in the U.S. It's got many projects, maybe 100 different projects. These two projects alone destroyed the at least the capital of the company, not completely. The company, when we make an analysis of M&A, we're going to look at, to get the valuation, we're going to look at different energy pricing, contracts, how assets are financed, how the resource, in other words, the amount of electricity produced by the wind, how to deal with uncertainty in that. Now, the good part of this is the company started providing a whole lot more data after the disaster, and we can look at a whole host of different regulatory regime issues, pricing regime issues, merchant hedging, a whole lot of these things, and also see that if you use ROIC, ROEC, ROCE, return on capital employed, return on invested capital, if you try to compute in your M&A model terminal value from EV to EBITDA, or use some formula like NOPAT times 1 minus G over ROCE divided by WACC minus G, if you use any of that, it's going to fail. If you try to use the same cost of capital over the life of the project, it'll be an idiotic valuation. And it, depending on the project, you really may or may not want to directly incorporate debt financing and compute valuation on an equity basis or an overall enterprise value basis. So that's a little bit of the introduction. You noticed I'm kind of just reading these slides. Sorry about that. Then I'm going to make a second video and see how long that takes of a model. Okay, now I have been. At first, I was given. They said, "Oh, no, just make a model of a M&A of a utility company." I didn't know what that meant, so we had to go back and really focus on things. We want a renewable energy. And when we make a valuation of renewable energy, we'll have uncertain resources, and we'll just do what we do in any valuation. We'll make a cash flow forecast and assign a risk and use some sort of discount rate and probability analysis of whether a development project actually gets constructed or not. We'll just use cash flow and risk, just like anything else. Okay, but when we do this, we've got to understand how the regulation works, how the pricing works, maybe a little bit on the financing. So we'll look at regular subsidy regimes. What happens if we have different risks of inflation? What happens if there are exposure to merchant energy prices? And how does that work? Excuse me, I'm glad I didn't cough on you. This was supposedly for M&A bankers, whatever that is, and they have no real experience with renewable. They have experience making three-statement financial models. What a bunch of shit. We're not going to make three-statement financial models. They said, at first I did this and did some exercises on Excel. They said, that sucks. I can do everything myself. Don't tell me anything about that. Okay, so that's what we'll do now. Just to summarize some of the concepts, I've already said this junk about discount rates. ROIC, ROE, the whole thing, the valuation driver formula, it's just irrelevant because of the changes in ROIC over time when you're a fast-growing company. There's no such thing as what absurd complete crap or WACC because of the risk changes over the life of the assets. And you will have to make some judgment about how that risk changes, and the best piece of information you can get is actual returns in real transactions. That's very difficult, if not impossible to find, but you can hear stories about that. Even some of the case studies these days that are given by the bank has of that. We cannot find standards for EV to EBITDA or PE or these kind of ratios. Maybe price to book we can. CAPM would be kind of worthless. Three-statement modeling is not useful. We will be able to see some evidence of premiums for renewable energy assets compared to, say, oil assets or other things. And we really want to understand at the kind of at the end the important issue of whether climate change is affecting wind patterns, and is there a permanent reduction, or is this kind of just normal cyclical variability? In other words, are cash flows mean reverting, or are there something more serious about changes in wind speeds that we have to worry about? So let's talk about Orsted. It doesn't finance its assets on a project finance basis. It was incredibly valuable, arguably one of the most valuable energy stocks relative to the amount that the invested capital, relative to the amount that was paid for by the assets. It had a very interesting disaster in the United States with political risk. I have listened to a whole lot of the earnings calls and the comments made by investors, and they really give you a little bit of insight on the valuation. Now here's a map they produce. This is actually not the very latest, but they wanted to build 30 gigawatts. Now, a nuclear plant might have 1 gigawatt, 1,000 megawatts. Currently, they only have 5.2 gigawatts of onshore capacity. So they want to grow this company really dramatically. In fact, I think they said they wanted to be like involved in half of the offshore wind that's produced in the world. So here's what has happened in the past. The orange or brownish line is their capital investments, and they started really, and I don't know, around just before COVID, they started really accelerating their investments. The blue line is their cash flow from operations, increased because of some assets coming online. But the capex is way more than the cash flow. The capex to depreciation is really dramatic. You can see it went up to 400%. Here's how the company describes itself. I'm not going to go through it, but it was a boring old utility company, and then they decided it was called Dong Energy at one time, a few years ago. And they see all of these exciting opportunities for wind onshore, but a lot offshore. That's where their big investment is. Now, their failure occurred in New Jersey, and the governor of the U.S. state of New Jersey called them incompetent and lacking credibility and outrageous company. Now, the company basically buys turbines. It hires the companies to put these things called monopiles in the ocean to support the turbines, and then it's got to connect the transmission. So those are the kind of things it does when it constructs a project, and then it owns the project. And by looking at this company, we'll be able to see a whole lot of issues on how the regulatory regimes work, really, what's the energy pricing, all those things I just talked about, and I'm not going to repeat all that stuff about the valuation techniques. Now, the way the company actually works is, I was a little bit, when I showed you that first graph, it was a little bit aggressive, because what the company actually does is they invest in project, and then they call it farming down or selling down the project. So they'll kind of sell sometimes 50% of the project. They continue to manage the project. And basically, when they sell the project, because the risk has gone down after you've made it through the construction and development phase, if the risk goes down, the value goes up, and for the same cash flow, you get a higher value. And so when you look at their actual kind of capex, they fund a lot of that capex with selling off assets, and that creates all this M&A work, okay, because we got to value those assets. Here's, just from their cash flow statements, here's what you can see is that in 1 year, they sold 120% of the assets. I mean, they sold more assets than the capex, and then here was 60%, here was 30%. So you can see the percent. More interesting, perhaps, is the gain, the percent, the gain on the sale relative to the asset, and they have some big gains here of 70%, 60%, sometimes nothing. And that, again, is a valuation issue. Now, if you have a company like this, well, you could be valuing one of the assets, you could be valuing a portfolio of the assets, you could be valuing the whole entire corporations, which means you'd have to put some kind of value on their ability to make economic profit on future investment. But that's what you do in any corporation. Now, I show you kind of, if you go to World Wind Map, just Google World Wind Map, you can sit there and just start staring at wind around the world. Now you can see that Not always, but the green area is the higher wind, and you can see higher wind offshore than onshore. And so the idea is to take advantage of the higher wind speeds, which are all also stable. This example I have here of somewhere north of Scotland has a 17 meter per second wind speed, which means the wind is operating, the wind turbine is going as fast as it possibly can. It's operating at capacity. Now, as we go through this case study, I actually suggested let's go through a little bit of the history. Let's understand where some of these ideas came from and see where we are today. And going through the history for me is going to be useful, because some people want to go back. Some people talk, I can't say make wind, make electricity great again. Ooh. And if we go back, it'll give us an insight to see kind of how things started. You know, look at this. 2 white people and a woman who stays at home cooking for the husband, and she has an electric stove. She might even have a dishwasher. She's got a washing machine now. Her life changes. These poor people have to do it, or a little bit different. But they talk really is. Can't say it very well. And let's look at that period. You know, the electricity grew by 7.3% annually, compound growth, and then it started slowing down here in the 70s somewhere, and then it stopped. That's kind of the history of electricity growth. When electricity was growing so fast, you could build bigger and bigger distribution systems, bigger networks, bigger power plants, and the cost kept coming down, the cost of like a coal plant. And they said, oh, that means it's natural monopoly. Here, GE was the most valuable company. It only earned an IRR of 15% to become the most valuable company in the world. Nothing like these GAFAM kind of stocks. The regulation system was cost plus. And here's what happened. We want to make utilities boring again. The whole industry in the U.S., the whole distribution industry, so many utility companies make their presentations. Oh, we're a boring utility with cost plus regulation. Forget all this incentive regulatory stuff. Forget all this PPAs. Forget all this non-utility stuff. We are boring. We're a pure play utility. That's what you want to show. And here's an example of a really company that's made a lot of money by charging high electricity rates. But they make a rate of return on equity of 12%, which produces, remember, these are capital-heavy industries. This has a whole lot of networks and distribution lines. And they build a distribution line, spend a book value of 1, and then they get that book value to increase. So these companies want to grow. This company had a IRR over a long period of time of 12%. Unbelievable, because that 12% means if you invested down here in 2002, you'd get 10 times your money back. Okay, just by being a boring company. Companies want to become boring again. Orsted used to be Dong Energy. Maybe it wants to become boring again. Here's another boring company in New York. The regulators aren't so kind. The cost plus regulation results in maybe here about 8% return or something. But even that produces a price to book ratio of a lot higher than 1. Go way back. It's somewhere here and to the 80s. This has produced a higher return than the overall market by a little bit. And there you see the returns. Now these, I have been struggling. One of the reasons I haven't made so many videos, I've been struggling with 3 big projects. One is a project finance model where the UDF is perfected. Second is this thing where you can't get the data the way you used to. It's so sad. You can't get it from Market Watch anymore. There are all these blocks and all this on this stuff. So It all works with a Yahoo ticker, and somewhere on my website, right in the database section of my website, I'm putting instructions on how to put a ticker in and then get this kind of analysis. And when you get this analysis, I also show the return on invested capital. So this is the first one. They're making 6% or something like that. That must be higher than the weighted average cost of capital, because the EV to invested capital has got a big premium, and I show some depreciation rates. And then I'm back to this Con Ed now, which is the New York utility. You can see kind of, for these companies, we got reasonably stable PE ratios, more stable yet EV to EBITDA ratios. And maybe if you have these stable companies, you can use some of the classic valuation formulas. You just take value equals dividend times whatever. I've gone through this elsewhere, but you can rearrange this formula, get the payout, get a formula for PE, get a formula for the price to book ratio, get a formula for the cost of capital. And when I put this cost of capital together for these boring companies, you get a required IRR, or a minimum required return given the risk of the company, of somewhere a little more than 6%. Okay, let's go back to Orsted now. This was a boring company, but it isn't. They decided to say, no, we're going to go take over the world in our offshore wind projects, and they obtained a 5.5 times market to book ratio. I obviously look at that ratio a lot, because we got again, I'm saying we have heavy assets, whatever, we have capital intensive companies, but it's hard to find anything that comes close to that in the industry. Remember, these are reasonably high. Now, for other companies, if you're earning a really, really high return, you can kind of get there. Now, because of this loss here in 2023, the company's performance is not so good, and this should have been 79%, because I just updated this very recently because of a certain man who's in the U.S. and changed some policies. You can see here we can't find any kind of stable ratios. So that's the first kind of point. Now, Orsted, it kind of is interesting here. When it makes any of its presentations, it always says, ugh. And listen, you will hear us say that again. The updated guidance is an unchanged 150 to 300 basis point spread to the WACC. So they want to make 1.5 to 3% more than their WACC. This is industry leading. What in the hell does that mean? Industry leading. I guess that implies that they can make a higher spread to the WACC than other companies. Okay? And that's kind of interesting if that's really the case. They also talk about their return on capital employed being 11 to 12%, which I suppose is supposed to be somehow representative of the spread to the WACC, which doesn't mean a damn thing. Okay? But they don't tell you. This company does not tell you what their WACC is. So I looked around, and part of that a file where we just put the ticker symbols, I put the debt to capital, the average interest rate. You can see the average interest rate is going up, which really caused consternation at the company. The debt to EBITDA is an indication of the credit risk. So I made up some WACCs so we can do some analysis. I said, let's give them a high 10%. I think that's really high. And that gives a WACC of 6.5%, and then we can add a 1.5 to get 8%. We can add 3 to get 9.5%. Okay, and look at those ROEs that come out of it. So when you add 3% to the WACC, you get the 6% on the 16%, go from 10% to 16%. Now this is so crucial to understand why you can't start the people who have made kind of traditional valuations, you can't do the same thing for an individual asset. This is the invested capital on the balance sheet. It goes down. If EBITDA stays the same and invested capital goes down, then your rate of return will go up and your value goes down as you don't have less and less years left, just like I do. Your enterprise value to EBITDA has the same sort of pattern. In this case, I think I put an inflation in EBITDA, so you've got a decline. That shows immediately you can't have any EV to EBITDA kind of criteria in your valuation. Then, in this case, we just had this is the price to book ratio, and in this case I had 3%, and this case 1.5%. And what you can do, it's very easy to do. You just make a little financial model of a single asset and say, okay, the project IRR you're going to earn, the project IRR is just you just take the EBITDA minus the capex and take the negative cash flow and from the capex, positive from EBITDA, and then you get the that gives you the required cash flow. You get a required price in order to meet this premium, and you put it together, and that gives you a 1.3 times price to book ratio, or 1.6 if you're making the high. So you can see that price to book of 5% was kind of crazy, and you can start to see where the value of this company, at least if you believe it, comes from. Now, I think this using the return on capital employed is kind of an idiocy. First of all, it's going to be totally different for a growth business. Secondly, they've got all these construction assets that don't earn anything. And third, they made these big write-offs, which lowers the invested capital. So the whole thing is all a distorted kind of mess. But we need to understand that. And if you've got one single asset, not a portfolio of assets, and your IRR is something like this 300 or 150 basis points, you're always going to earn less in the early years of an asset and higher in the later years. And if you put this together for a company that's got a whole bunch of a really, really fast rate of growth, you'll see the same kind of thing. And it's just so basic. It happens with any kind of company. And if we... here, this is for Orsted now. You can see the return on invested capital went down, up, down. This is when they had to pay some cancellation fees, and of course the ratios aren't the same. Now, what I've done, and I'm going to waste just a couple minutes on this, is I try to simulate, and this is another big spreadsheet that I've provided on the website, and I think it's really important. So what I do is I put a whole bunch of single assets in for all these years, and then consolidate them into a consolidated file. So we build some assets and assets and assets and asset and keep going on, and we can put different growth rates, different premiums to the IRR, and see what happens. And when you do this, you kind of get, eventually it comes down to a stable capex to depreciation, but it's a lot more than 100% because you're keeping growing the assets. The depreciation has kind of the history in, and all this accounting distorts things a little bit, and the ROIC starts low just for like our single, and then we hit a stable stage. And when you hit a stable stage, the return is equal to that project IRR. What that means is our boring companies, this return really means something for our boring companies. For Orsted, the return means a whole lot less because it's distorted by this very rapid growth. I hope you can see that. And again, it implies that when we make our valuations, we can't start applying some traditional stuff and start worrying about what's on the balance sheet and return on invested capital. So when I do this again, if we look at a PE ratio or EV to EBITDA ratio, that changes dramatically as the company stabilizes, because at first we have these value from the long-lived, we have the value being high relative to the earnings because of the long-lived assets, but here we have to start replacing the assets and it all stabilizes. The price to book is more stable, or the price to EV to enterprise, and I think I forgot what I used here. You can get eventually a stable ratio, I guess. Now let's move to Orsted and some of the interesting things that happened with this company. Okay, basically here's what the company does. It goes to Vestas and says, I need to I'm going to pay for a turbine. It goes to another company and makes a little contract with them that it installs a monopile. Okay, and then Orsted has to do some labor and have to hire some labor to put all these things together. That's what they do during the construction period. Now, this is something that's going to drive me crazy for the whole thing. Orsted says we have FID, and they're all proud of their FID, and that FID stands for Final Investment Decision. And they had one single asset that they canceled before the FID. Now, I would think the FID, if that's like financial close, here's what financial close means in project finance. It means you've signed contracts and you've reduced the risk. You've signed fixed price contracts for construction, for operation, and you've signed a loan agreement, and you have an agreement on how the revenue is going to be produced. This FID kind of sounds a little like FC, but it's totally different, as we're going to see, because how did 40% of its equity go away? Now, here's the project in question. This is a project near New Jersey in the U.S. And they signed a 20-year, they called it a OREC. They love these stupid little acronyms. Offshore Renewable Energy Certificate, which basically says take the market price of electricity, which in the U.S. is really low, and add 84.3, which is a gigantic amount, USD per megawatt hour, and allow that to grow by 2%. So they negotiated this price, and then they also gave $100 million, not much, whatever, to New Jersey, and they used GE turbines, which was important because these were turbines built in the U.S. and this protectionist and the whole thing. By the way, in this you can see this is the Tornado Alley. This is where you build onshore projects in the U.S. Okay, again, that's just, you should go to this, what is it called, World Wind Map, and just stare at these wind for like hours. Okay, so here's what happened. They didn't reach FID. They didn't reach the final investment decision, which means God knows what. They spent $2.79 billion, or they took a write-off of $2.79 billion on, this is Ocean Wind 1 and 2, that's what they're called. They took another write-off on somebody else. They took $3.46 billion in write-off, but that's not all. They had to pay cancellation fees of $2.1 billion US. That means a total loss of $5.56 billion, which is quoted in the Reuters here. And their equity before the equity on their balance sheet was about 14.5. So this single investment got rid of 38% of the equity on their balance sheet. I just have to close the door because people are watching some inane wheel of, oh God, whatever now it is. Here is our basic question. if it's not FID, what are you doing spending all that money? How could this happen? They're supposed to be really good at securing these monopiles and getting everything done. What in the heck happened? Morgan Stanley asked in one of these meetings, you seem to have two very late notice disappointments from suppliers on foundations and vessels, which is very surprising for a developer with such a strong track record. It's almost sarcastic there. And then this information they got is just a bunch of gobbledygook. That's their response. So what they said happened in more detail is they called it supply chain changes. Okay, we blame all that on COVID and all that around the vessels. And they said this means we'd have a multi-year delay in the entire project and we'd have to go and recontract the scopes. They didn't have anything fixed. And then they said, well, the whole cost of this project would be $6 million per megawatt. So you take the megawatts, multiply by 6 million. That's what's supposed to be the total cost. But the write-off alone is 4.26 million per megawatt. So it's kind of hard to see what's going on. After this problem and a problem with lesser problems with a couple of other projects in the U.S., this was something interesting from an analyst who said, here's a question I get, and I'm sure you get those kind of questions. Investors do understand that you have a portfolio of operating assets, and they love that because the risk is lower on those operating assets, obviously. But what investors are not buying is the conditional crap related to, when Orsted says, I hope we can get this tax credit, bump in tax credit, better negotiated terms. Investors don't put any value basically on that. So he was begging to to allow investors to see the value of the existing assets versus new assets. And indeed, the company did provide some. But if translating this to valuation means that we cannot apply the same cost of capital to a development asset as we can to a asset that has made it all the way through construction. That's kind of basic, and it has nothing to do with project finance or anything else. Now, what you can also do, and I hope for me this is a lesson, instead of, you get all these fancy things where people kind of come up with these valuations and everything else. If, let's just say here, the company has $78 billion in equity after the write-off. And let's compare the value of this $10.9 billion in equity to the write-off itself and see how much value is created by this. Now, if you take this 10.97 and the cost of equity, this is equity on the balance sheet, not invested capital. You say it lasts for 20 years. You just use a PMT formula, and that should, if we produce level income, that produces level income of 1.29 billion per year, and you take the PV of that, 1.2 billion, add the 10%, you get back to this number. That's just if we earn our cost of capital, our book value, and our market value are the same. If we make this a spread of 1.5% or 3.5%, we get a higher return, meaning that we get higher income. We PV this income at the cost of capital, and when we PV this income, we get this number. But this number, so the value of that premium for every single other asset, if you do a back of the envelope analysis, which I encourage you to do, produces less value than the write-off itself. That's how big this thing was, and that explains the stock price decline and everything else. Now, I started this little discussion about a boring utility and les 30 glorieuses, okay? But after what happened, let's go through what happened. And in 1973, there was something that really changed the world. And when these horrible people say MAGA, they sometimes, I think, wish that they could go back before this oil price went up. And they could drill, baby, drill, or some crap like that, okay? When the oil price went really high, the world changed. And suddenly our costs weren't declining, and suddenly our oil plants and our gas plants weren't the same, and we started to say, okay, let's build nuclear plant or maybe renewable, because in Denmark they had kind of a debate about all that. Now, here's what happened. We applied cost plus regulation. We applied the old kind of regulation to these nuclear plants. This is called the Seabrook nuclear plant. The current nuclear plant that I'm working on kind of looks the same, actually. It cost 1.1 billion, but then the cost escalated to 5.2 billion, and they said, we have cost plus regulation, we need our rates based on this instead of that, and that caused a lot of discussion. How's that? And we moved to a different model. We said, this is bullshit. These plants, if this was a little gas plant, they don't have economies of scale. There's no reason we can't put these out to bid and impose the risks of these construction cost overruns, just like we saw with Orsted just now. Let's put these risks on the companies that are building them. And the way we'll put those risks on the companies that are building them, we're going to have a bidding process where the lowest bidder wins. Now, once you win the bid, then you can sign a construction contract and fix the construction cost and put the risk of that construction cost over on the construction investor. Now, that idea to impose, and to be careful about it, to impose risks on investors where the risks can be controlled is an idea that's still here today, and it's an extremely important idea, and I think a generally good idea. Now, risks about a fuel oil price going up and down, we'll look at our oil price. These risks, if investors had to take these kind of risks, well, then they would start demanding a much higher IRR. If they demand a much higher IRR, then the price goes up. You know, Orsted would want 10% plus the WACC or something like that. Another risk is the risk of the amount of generation that comes from a dispatchable plant. You can think of a dispatchable plant as driving your Ferrari. You can push your accelerator down, and you can control how fast you're going and when you're driving and everything else. You can control assets. Now, the person who controlled the assets was not the investor. The person who controlled the assets was actually the contractor, the person who signed the PPA contract, the entity. And that means we can't impose that risk, just like we can't impose fuel price risk. We can't impose that risk on the company. If we did, they again would charge a really high IRR. Orsted would need this high WACC premium, and the prices would be much higher. So the idea was to carefully allocate risks that could be controlled. I think it's probably a decent idea. Now, one of the kind of little nuances about this is, what do we do about risk of inflation? And this is, Orsted really complains about the risk of inflation. Now, Orsted would love it if in the power contract we have a price, and that price goes up with the actual inflation rate. And their particular problem was inflation during even the construction period. And they love the UK because they have inflation protection in their contracts, which means the real WACC, or the real premium above their WACC, adjusted for inflation, stays flat. If it's nominal, if it's just a fixed price, you still get the same IRR, but an IRR, if there's 10% inflation, means a hell of a lot different than the IRR if there's no inflation. Now, this shows you the kind of distribution, and Orsted has a lot of this inflation indexed revenue, so they present this saying, oh, look, we've got lower inflation risk. Now, of course, I shouldn't say of course, because there's a jerk on the internet who says of course like that. When they're trying to say that we've got 45% of our revenue in inflation-adjusted contracts, because their biggest contracts are in the UK, by the way. There's the when I just said of course, I meant to say that the WACC would be different or the cost of capital would be very different for an inflation-indexed contract than a fixed nominal contract that doesn't change. And then they have some merchant exposure, which we're going to talk about in just a minute. Okay, so here's the, we have to be a little bit careful with inflation, because think of this from the perspective of a bank who likes a debt service coverage ratio to be stable, and a bank has a fixed interest rate. They use interest rate swaps to fix the interest rate. If they have fixed revenues and fixed nominal interest rates, the interest rates are all nominal, and fixed repayments, then they would rather have the bankers would rather have a fixed price. So there are nuances around all of this, which makes this interesting. Now, Orsted, here, they said, for example, Orsted said this year that its Hornsey Sea, the biggest project in the world, I think, won a contract for £37 per megawatt hour, was at risk unless the US government increased support for the project. And they did this with some other projects. Basically, they want to go back to cost plus. They say, oh, our cost went up, our supply chains went up, we need to increase our costs like cost plus. This is just so against the whole idea, but that's what they're trying. Now, the idea, again, I've kind of said this already, but this is, if this was project finance, you'd put the ocean wind project or something into a special purpose vehicle, you'd bid on the price, get a fixed price. Once you get a fixed price, you get fixed capex. Once you get fixed capex, you fix the O&M expenses. Then you show the banks, we've got all these cash flow fixed, and then you got an equity IRR, and the whole business of valuation is judging that equity IRR. And this is just a little more detailed kind of thing where you show how much you're getting for a contract. You show that you have a contract fixed for the O&M, fixed for the construction, and then that enables you to get a loan agreement. That's project finance, and Orsted is not project finance. And one of the most interesting questions that this case raises, I've got to take that this case raises is the discipline that the banks make you go through in project finance, is that a good thing, even if you have to pay some fees and you have to moan about the banks limiting the financing and everything else? I think, based on that disaster of one single project that didn't even hit FID. So what does that FID mean? What a bunch of bullshit. It didn't even... You spent these billions before you have this mythical date called the final investment decision. What in the hell is going on? If we have banks checking that you're doing things right, that should give investors a whole lot more comfort. They did... Orsted does talk about this thing called EPC wrap, and the EPC wrap means that you're wrapping the whatever. They said when we sell the assets, we can put an EPC wrap or not on that. That means you don't only fix the price, you fix the timing. So if there's a delay, the EPC contractor, the person building, the company building the project, accepts that risk, and you also have a wrap on the performance, the efficiency of the project. And that's possible to do. Okay, so, and finally, we're going to now move to the structure of renewable investments relative to dispatchable. A fireman is dispatchable. A fireman puts out fires, okay, but they also sit around and watch sports and talk about politics and all this stuff and come up with crazy stories. I understand there are psychological studies of all this. You would not pay a fireman for putting out a fire. In fact, if you paid a fireman a merchant basis, as soon as the fire goes off, they'd start negotiating with you on what kind of price there is. And if there are two fires going on, they'd get a higher price and all that. A fireman gets a fixed reserved price, which is how these original PPA all worked. And if they are available to put out the fire, they get they get paid their salary. If they're off, taking too many sick days, then they don't get paid. It's exactly the same kind of process. But renewable energy is different. Remember, the whole principle of the regulatory regime is that you get paid based on things you can control. Now, I put this picture here of this tree. I think they put this picture of this tree. Can you see how it's a little bent? That means the wind's probably coming from this direction. That's probably what they wanted to say. But I use this picture differently. If the wind's coming from this direction, it's a pretty stupid place to build a goddamn wind farm, because you're going to get a whole lot less wind because this tree is blocking the wind. And if you're stupid enough to put your wind farm here, your windmill right here, you should get penalized for that. You can control where to put the wind farm. You should put it way over there somewhere, and without any trees. Okay? You can cite the wind where it's windiness, where it's most windy. That's the whole idea. So in renewable energy, unlike those firemen, we get paid when the wind is blowing, and if the wind is blowing, we don't get paid. And we have to structure our contracts like that for incentive purposes. Now, the way we can do this, one way to do this is, and the way this renewable energy industry really started, with feed-in tariffs. I'm using the example of Germany, which is really raises some interesting questions about government regimes and everything else. They started with a feed-in tariff of 45.7. This was a simple feed-in tariff, no inflation, just flat 20-year feed-in tariff, no negotiation. You put a solar project in, you put a meter, pretend this wind is solar, you put a meter next to the solar project, it measures how much solar is produced, and you get 45.7. This 45.7 is euro per kilowatt hour. This is euro cents, rather. This is euro cents too. It should say cents right here. The market price, the merchant price, which we haven't really talked about, was the highest it ever got here, was 7, right in when the oil price and gas price went up. And the merchant price is always, in every single case, the gas price, which is the red line, follows drives the blue line, really, okay? And so here the price was $3.45. Oh my God, what a subsidy were they giving? But their idea was, look, it was kind of the very beginning of our whole discussion. If we have economies of scale, if we start increasing scale in an industry, we can reduce the cost. And they were able to reduce these costs. Right now, you can build a solar down here for about 1 cent in Saudi Arabia, for example. So this government policy of giving a really big subsidy really worked. It really, really worked in solar. And the reason it worked is the Chinese came in the market. Here's we go all the way back to the 1980s. The cost of a solar module or panel was about 7,000. Now it's less than 100. 7,000 down to 100. Here, if we just go back to 2015, the price was 600 for a panel per kW, and the price is now less than 100. Okay. Now here's the project finance diagram for renewable energy, and we have all the contracts for EPC, O&M, shareholders agreements, loan agreements, subsidies got paid, and government pays the tariff, but we get to the volume because the revenues we get are the volume here times the price, and this is not predictable. So when we make a valuation, we have to do a whole lot of resource analysis to understand that risk. Okay, now before we kind of get into some of the more interesting details, let's just talk about and we can use Orsted again because they list out the different contracts. Here's how a feed-in tariff is kind of working. This is from the Netherlands. They put in an estimated cost of the project. Remember, this was 6,000. This is euro per kW, not per megawatt. Blah blah blah. Okay, and they put some estimates of the O&M costs, and then they put some cost of capital in, and then they come up with prices, and if you're in the red area, that means there's more wind and you get a lower value. If you're in the blue area, there's a lower wind speed, so you need a higher price to offset the lower quantities, and they targeted a rate of return on equity. So for this perhaps Orsted would say, oh no, this is just a little bit above our cost of capital. I think it's a lot above, but whatever. Okay, that's how it works. Now, Orsted shows for offshore wind and a little bit for onshore wind all the different tariff schemes they have. And they give you kind of the tariffs in the local currencies. And so for instance, in Denmark, there's a feed-in tariff, but it expires after a while. It expires after they produce a certain amount or after some years. And this is the initial feed-in tariff. And after the feed-in tariff is expired, it goes to these merchant prices that I have still not discussed. Okay. And then in Poland, they have this thing called a contract for differences that we're going to get into. It's like a forward contract where they fix a forward price. And this is a reasonably low price, 76. I don't think it's that low, but compared to the other projects. In Germany, they have a lot of feed-in tariffs. They have one that's kind of a market price, and I think that's our corporate. It's called a corporate PPA, which we'll look at. The Taiwan has feed-in tariffs, but these are higher. And the reason they're higher is because there's probably lower production. There's almost certainly lower production. In the U.S., they have these negotiated kind of things that I showed you with these ORECs and all of that, okay? In the UK, which is where they've got the really big plants right here, they've got the really big projects, they either have something called a Renewable Energy Obligation Certificate, which is called a ROC, which I never knew really what it was. And a ROC, you can have, there's a ROC, and this could be worth 2 ROCs if it's offshore wind. Here, the offshore wind was only worth 1.5. I don't know if they changed the policies over time. Each ROC, one ROC gives you, in this case, in 2023, it gives you 59 pounds per megawatt hour. I should have maybe put that in the title. And then you multiply that by 2 or 1, and you get the subsidies. And these subsidies are all pretty high until you get this contract for difference, which is they changed the scheme after a while. You can kind of see where they changed it. And Orsted, in its cowboy type whatever, bid 45, which, God, if you could get that, really would change the world. I would say we should be building offshore absolutely everywhere. But we saw that now Orsted is going back and saying, no, I was wrong. Okay. So that's a little bit of background on this stuff. Now, if you've got something like a contract for difference, or certainly if you've got a corporate PPA, yes, why is it? Yeah, okay. If you've got a corporate PPA, here's what happens. Remember I said with a feed-in tariff, you put your meter here and you get paid. Now, if there's no, if for these other types of structures, and you'd have to look at details on each one of them, if you've got a transmission line and the person is living here, if there's no room on the transmission line to get the power that's being made, you don't get paid. That's the difference between a feed-in tariff and something like certainly a corporate PPA, or it could be depending on how the contract for difference is structured, it could be it could be that as well. Okay, so here's a discussion where Orsted, like other things, it had a problem with delivering the power, and they said, everything's okay, don't worry about anything, we're just good. Okay, and there's a little more discussion. There's I mentioned a corporate PPA. That's where somebody like Google will sign a PPA with you, and that means the government is not subsidizing the price by definition, and they were able to do that in Germany, perhaps because the prices are so high because the people are paying for all these other subsidies, whatever. And let me take a cup of water. We're above an hour. That's good. That's good. The timing is about what I want now. Okay. In that case, if you can't deliver the power, you don't get paid, typically. Now, let's talk about merchant prices. I've kind of skimmed around the merchant prices. And here's some of the history of this is U.S. when people were building coal plants. Still, you'd be surprised how many coal plants there are around where I live. Then there's the nuclear age, okay, which is cost plus, which caused all these problems. And this is where they started the kind of PPA, the kind of contracts. Okay, and then we had some hydro, but that's all used up. And then all of this merchant plant came in. So here's what the idea was, that we said, okay, and the first thing I do with discussing merchant is show you some prices. And I would always compare the price of electricity and the price of natural gas. And you can see high correlations here. It's kind of interesting that in relative terms, price of electricity went below the price of natural gas. This could be from oversupply, new renewable energy, from the feed-in tariffs, all sorts of different reasons. This was Mr. Putin going into Ukraine and all the problems with gas. Okay, now, the idea of merchant plants is, let's forget this guarantee of this fireman stuff. Let's open the market. You get paid if you're a merchant plant. You get paid the blue line, and you have to make a forecast. And if you're stupid enough to want to build a coal plant when gas plants are more economic, you're going to get a lower price, and you're going to be run less, and you're going to make a really low IRR. If you can figure out a new innovation or something like that, you'll get the market price, and you'll be able to earn a higher IRR. I think it's very controversial to this day whether that really works, and it's got a kind of funny thing happening with renewable energy. If the price is really high, renewable energy does really well if it's merchant. If the price is really low, renewable energy does badly. And what that means is renewable energy really has gas price risk in it. A gas plant, on the other hand, they buy the gas, they buy the brown line, and they sell the blue line. Now, they would have had a bad time here compared to here, but they have a kind of natural hedge that a renewable energy plant doesn't have. So a renewable energy on a merchant basis has more risk than a gas plant, which is kind of really unfair. But it's related to the fact that these markets are based on variable cost. The reason gas typically drives the price is if you think about turning the light on and off. If you turn the light, look at me looking upstairs at the light. If you turn the light off, one power plant is going to operate a little bit less. And that power plant is going to be the last plant that's dispatched on the system. It's going to be a gas plant, probably, not always. Okay, but that's why you have these things. Now, if you look at things on an hour-by-hour basis, it's not. The correlation certainly is not perfect. And this compares, I don't even say where this is prices in Germany. And there's obviously some renewable energy in Germany. So sometimes the price gets really low, but kind of it follows the gas price. Once you do this average, this is DK2, this is Denmark outside of Copenhagen, and you can see that the price is highly correlated. Now what you can do is add wind into the equation. And the wind production is published by this wonderful thing called Nord Pool. At least I used to think it's wonderful till they raised the price and I can't afford to buy their stuff anymore. Here's what happens. The blue line is the amount of wind production. The orange line is the price. And when the wind production is high, the price goes down almost to zero. When the wind production is low, the price goes high. That doesn't always occur. I had to do a lot of work to kind of find a month where this was nice. And was this a month or a week? I think it's a week. Use 1 week, right? But this is over a longer term. It compares France with all the nuclear plants to Denmark with wind. And in Denmark, when the wind is really high, the price gets really low. That's to be expected. So you've got a lot more volatility in merchant prices when we've got more renewable energy. This is what everybody says is going to happen, and you can see it happening almost more in Denmark than in other cases. Now, what happened with all of this merchant price is basically a whole bunch of bankruptcies. And investors still hate merchant prices because of all the danger. Most of these bankruptcies were in the U.S., of course, where we got all this political risk. And here's a German company subject to merchant prices. You can see that their returns went way up and way down. So now, with all that, let's talk a little bit about hedging, corporate PPAs, and other things with renewable. Now, here's what, again, this Orsted really does provide a whole lot of issues around the industry, because they say, well, we've got fixed price subsidies. This is just fixed prices. Good. Then we've got guaranteed prices with some upside. Then this lighter blue is as generated PPAs. Well, that's the corporate PPAs. That means you've got a fixed price, and I don't know why you wouldn't call that kind of almost like a fixed price. It's not a subsidized price, I guess. So that's probably some of their offshore wind. And then you have the two gray areas. The light gray one is fixed volume hedges. So they say, don't worry about our merchant exposure. We've got it fixed. And then they say we've got a little bit of pure merchant. So they're trying to show just how little they have. And then they have a little illustration. Texas, the idiots, didn't have their stuff right in the wintertime and had this enormous price spike. But now you've got a much lower price. And here's the forward price. This is the kind of historic price and the forward price. And what investors would love is if this forward price was really high and you could lock in the merchant revenues at a high price. Okay, now let's talk about something crucial. And we talk about a forward contract versus the CFD. Where did I put CFD? I didn't put it there. Versus a contract for difference. And it was confusing to me for many years. But when you think of an interest rate swap, an interest rate swap has to have an amount. You make an interest rate swap based on the amount of debt you have outstanding, and you predict the amount of debt you have outstanding over time, and then you call that amount of debt a notional amount. And you do the same thing with a natural gas contract, a exchange rate hedge. All of these things have a fixed notional amount. And you basically settle this, whatever. If the interest rate is higher than the fixed rate, you pay the one party, the other party pays the other party, blah, blah, blah. Okay? A contract for difference has the same kind of thing. It's got a settlement, it's got a defined term, all that stuff, kind of like a forward contract, but it's based on production and not a notional amount. And that's a key difference. Now, here, pretend you're the counterparty and making a hedge. What you can do is get nice hedges on the natural gas price. You can get a forward contract on the natural gas price, and then look in France. We can look at this relationship where we take the electricity price divided by the natural gas price. That's called a market heat rate, and then we kind of fix that, and we can create a hedge. But that hedge has to be based on a notional amount. Can you imagine if, let's look at Denmark, where we have a completely different situation, and if you're going to have no production, well, first of all, it's really harder to make the hedge anyway because of this zero price to the high price. But if you do, you better know how much you're going to hedge for. Here's an example of a swap contract. But here's the problem. The problem is if you have a wind farm, you don't know. It's not like an interest rate swap where you know the notional amount. You don't know it. So if you produce, let's say we're producing 100 because we've got some wind, the fixed price is 40, the merchant price is 5. So the price is really low. We want to get back to our 40, so we get 5 from selling the wind, and then we get a settlement of the remainder. But now we have production of 0. And if the notional amount was 100, we would have to go into the market and buy the power at a high price to offset that. So we'd have to pay in our settlement 160, but we have got no power to offset that, and we take a big hit for that. And that's called over-hedging. And of course, Orsted did that. Okay? What they do is they talked about that a couple of years ago. We saw negative effects from hedging. We hedge our future production, and they don't really explain what happened. Settle up. We describe this as intermediacy. When we enter, we have trades to mitigate, but they don't say what they have. Misalignment between the volume of the actual versus the volume that was hedged, the notional amount, and they took a hit because of that. And that's the problem, and we can't get kind of away from that problem other than making sure that we kind of doing scenarios that where we don't hedge 100% of our production. We hedge a whole lot less. So it's an hour and 13 minutes about, and I'm going to continue. Now the big risk we have to deal with is the risk of production changing. Now, it's kind of interesting. When Orsted made its 2023 kind of presentations, it gave you the transcripts, blah, blah, blah. This year, suddenly it gave some financial data. So apparently they're heeding the comments of that one investor and saying, oh shoot, we're going to have to show people what the value of our existing assets are. Now this production is, we remember the picture of the wind and the sun. That's not hedged. Here's what you do. Before the plant is built, you make an estimate of the production. This is from a resource study. And in this resource study, this plant at 94 megawatts, I almost said megabytes, 340 gigawatts. Now we take this 340, put another 3 zeros, 340, 300. That's megawatt hours. We divide it by the hours in the year to get the average. Amount. And I didn't put the number here. You take 343 times 1,000, divide by 8,760. 8,760 is 365 times 24. You divide that by the 24, and you get 41.3. That's one of the things they do. They estimate the capacity factor, and they get it wrong sometimes. They have to estimate this thing called the wake effect, the availability. They have to estimate all of these different things and many, many others. Okay, and then after they make their estimate, they say, okay, we can get things wrong. The wind speeds can change. But we start with something called a P50. That's an expected case. And then we get a downside case. And the downside case says that there's a 99% probability that you're going to be above this very low downside case. That's bankers love using this and love imagining that you can really evaluate probabilities in this kind of analysis. They're often a lot more arbitrary than you could have ever imagined. But that's the kind of thing that's done in a resource study. And here's the actual capacity factors in Denmark, which went up and down. We had some low years, high years. And, this would hopefully give you some comfort because there's some up and down, but eventually we get back, and that's what Orsted always says to his investor. Don't worry about wind speeds. They're totally fine. Here's an example of a disaster. One of my favorite graphs. I can't not include this. This top line is P50. The line just below that is P90. P90, if you think about it, it's supposed to happen 1 out of every 10 years. And the actual is lower than not the P50, lower than the P90, not once in 10 years, but basically every single month. And it's not lower by a little amount, it's lower by a big amount, and it's probably due to transmission constraints. And it shows you how risk changes, and making estimates of how a wind turbine will work before you've got the actual real data has a lot of risk. So once we get actual data, the risk goes down. That's the kind of point I want to make. Now, the way you actually do this is you get every single hour of wind with a test site. You take this wind and you array it against something called a power curve, which says down at the bottom, here's the wind speed. So we take every single hour of wind, blah, 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 and we put it, and we get every single hour of production. And this production, if the wind speed is really, really low down here or something like that, we get no wind. And then this is a curved, like a cubic kind of function, which is really important, which means a small change in wind speed can produce a very big change in production. This is the production over here, this is the wind speed over here, and different power curves give you different results. And Orsted is supposed to be expert at all that kind of stuff. Now, we're getting towards the end. Here is, they allow you to compute these capacity factors, here, this one, for different wind projects. Here is a offshore wind in the UK, and we have these kind of capacity factors. It went down here, which was a little worrisome, but it came up here, and you might say, okay, there's some cyclicality, but maybe we can take some kind of average, and if we're making an M&A analysis, we can take some kind of average capacity factor, or maybe we can even take some low ones and some high ones and do some sensitivities. That's okay. If things are cyclical, that's good. But here's something a lot more worrisome, and it's fascinating that when you ask Orsted about this, or the investors ask Orsted, they say, oh, no problem. This decline in capacity factor in Germany has been extreme, and I think there are other projects in Germany that had almost the same kind of decline, and people are worried about global warming and the changes in wind patterns around the world. I forgot all the analysis of that, and if that occurs, that's a lot more scary. You can't kind of take a long-term average. That's a lot more scary than just an up and down. And here are the Denmark projects, and you see something similar here. This is a decline, and it's something to really worry about, and it's something, if you're working on a M&A analysis, you would definitely ask the client a lot of questions about this and come up with some scenarios. So here's what Orsted does, is they say, oh, look at our load factor over time. It's about the same. It goes up and down and up and down. And basically, what's happening is just because they're putting new, different kind of projects in, it's hiding the effects of this potential, very scary, permanent reduction in this wind speed. This thing is really 29% when it used to be about 40%. Oh, that's a big difference. Okay, if we look at the onshore, I computed the capacity. They don't give you the capacity factors. You have to compute these, just like I showed you. But if you look, these are U.S. projects with high capacity factors, but this 47, 50 to 41, 42 to 38. Maybe it was just bad, one bad wind year because, these things, or maybe this was really good or something like that. But it's another scary kind of thing. Is this a permanent change? And you want to get as much history as possible. And once you get the history, you can get, at least the risk is less, because we've got real data. Now, I've got a few kind of ending slides. I don't think this is a comment. That they were just complaining. Every time you give us another update, things go wrong and wrong and wrong. And then they say, oh, we try to maintain a BBB credit rating. And they're very much more worried about their credit ratings these days, which means they're starting to sound like a project finance kind of situation. And then recently we've got political risk in the U.S. because we're going to halt all wind farms on federal lands, meaning that Orsted set up all these offices in the UK, made all this effort to study and get into this market, and now they can continue their existing projects, although some of them I'm not sure if they've kind of half pulled out of them, and what in the heck has happened? I think the political risk in the U.S. is more than Nigeria. Sorry about that. That's enough. So let's get into, then I'm going to make another video on our second project.